Well, investors in this country have a range of options if they choose to invest in the retirement home sector. Chartwell, Extendicare, and Sienna Senior Living are three major Canadian retirement residence stocks. All three stocks are up more than 30% so far this year. There's a quick look at how they fared on Friday. It was a down day. For investors looking to invest in senior living, our guest is here to compare and contrast these three stocks. We're joined by Neela White, Senior Portfolio Manager at Blue Wing Advisory Group at Raymond James, who has a history in geriatric care as well. Neela, thank you so much for joining us.
Great being here today.
First of all, let's talk about the macro backdrop. But what is the macro backdrop like for this sector of the economy and therefore these stocks?
You know what? I think we're in a very interesting time, both in North America and globally. You know, by 2040, 85-year-olds are going to double. We're at an all-time low for senior housing starts. Right now, the government had proposed for about 30,000 new beds in nursing homes, so that's long-term care, to be opened up. We're just over 11,000. But the reality is that's by 2028. By 2030, there's going to be a demand of 200,000 beds needed for our seniors.
We need to distinguish between retirement residences and long-term care, correct? Are these three businesses involved in both of those realms?
Yes, to different extents. So I think the important thing that everybody has to understand is the structure between long-term care and retirement homes are different. So long-term care, it's needs-based. It is co-funded by the government. There's a waiting list in Ontario right now of just over 45,000 long. Whereas retirement homes, it's private pay, it's really budget dependent. Can you afford it? And it tends to be a more social model as opposed to long-term care is more of a medical model. And when you compare and contrast the three names, Chartwell, Extendicare, and Sienna, their portfolios are made up differently, which means the revenue that they receive is broken down a bit differently.
Jeff.
Yeah, I was going to actually ask on that exact point, actually. Well, all three are labeled in the kind of the same arena. They're all a little bit different.
Yes.
Maybe you can share a little bit more about the occupancy rates of each, but more importantly, actually, the percentage of revenue that's government-driven for those as well.
Okay, so if we look at Chartwell, Chartwell is almost predominantly retirement homes, and right now their occupancy with last quarter was around 88.5%, and their revenue, because they're more retirement homes, only about 30% of their revenue comes from government funding. The rest is private pay. When we look at Extendicare, that is more of a long-term scenario, so more of the revenue comes in from the government. About 70% of their revenue comes in government, so we can see how stable that is. And their occupancy is just below 98%, so you see where the demand is. And then we look at Sienna, which has a bit more of a broad-based portfolio. About 60% of their revenue comes in from government grants or government pay, and their occupancy right now is just below 91%.
Okay, talk to us about Chartwell. Let's zero in at each of these stocks or units in particular. Chartwell has had a very good year. It's up 32% so far this year. Do you still like Chartwell at these levels?
You know what? I still do. I still like all of those stocks just because even if they have a blip in the corner, and we saw obviously with COVID, all three stocks were just beaten down. The bottom line is the demographics are still going to support it, and the end result is if you can't age in place. So interestingly enough, Extendicare has aging in place services, which means if you choose to age in place, you can get care in the home, but the care in the home is around $35 to $55 depending on how much care you need. So when you even look at the cost, you know, a Chartwell could be anywhere from $5,000 to $12,000 a month. And long-term care, the most expensive room, because it's government appointed, it's $2,909. So there's quite a difference. So yes, because if the room's full at the inn on long-term care, you still need somewhere to go if the budget suits.
Extendicare, let's go to Extendicare. That stock is up 38% so far this year.
Yeah, and again, I think the stability with Extendicare is because most of their revenue is guaranteed by the government and they have such a full occupancy. With the amount of seniors that are going to need care, especially by 2030 to 2040, I think, again, even if there's, you know, quarter on quarter where they may not be as up, I think the revenue is still going to be stable, like an annuity.
Jeff?
Out of the three, is there one that's a real standout in your mind from your background you think could be the winner in the next year or two moving forward as the demographic shift continues?
I fluctuate on that one, and it's only because of the price point. You know, you really have to look at what does your retirement plan look like that you can afford $5,000 to $12,000 out of pocket a year. So I think when I look at it, I would still like extended care for the stability because they have such a big long-term care portfolio. I still do like Chartwell, though, just because they're making big moves in memory care. And we know that the demographic for dementia people are rising globally and in North America. So I think as retirement homes become more focused on what the aging population is needing, and they offer bigger and bigger menu of items, which is out-of-pocket pay, you know, Chartwell's still probably one of my more favorite ones as well.
Okay, and let's talk about Sienna in particular as well. Another remarkable performance, 40% so far this year has been and that's only price appreciation. That doesn't include the dividends that these pay. Do all three of these pay dividends, by the way?
They do, yes. I like Sienna as well, just because they actually do have a partnership in the U.S., whereas Chartwell has no U.S. affiliation. Extended care sold out of the U.S., I think, in around 2015. Sienna has a partnership with Sabra Healthcare REIT, and they manage 2 properties for Sabra in Ontario and Saskatchewan. So when you look at the footprint, I think the fact that they're extending their reach into the U.S., which has the same issue that Canada does, I think it just bodes well for the stock in long term.
What do you think of some of the negative pushback that this sector has received from the political left, I'll call it that way, that says that the way to care for seniors is government funded. These entities are government funded to a large degree, as you said, but government built, government operated long-term care homes.
I mean, if there were enough beds, I would say this is great. You know, if everybody who needed a bed, got the care they needed, that's fine. But because we're not there yet, I think the issue ends up being residents have to go somewhere, and they do need care. And if that can't be done at home, or even the cost of aging in place, if that's not supported, you know, you do have alternatives. So I think it's 30,000 are supposed to come online. We're only just over 11,000. So I look at those gaps that we're seeing in the healthcare system, and they aren't changing, as well as the fact that even with the personal support care workers, we're understaffed, right? And that's currently, let alone with the projected number.